Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, as we approach the end of what has been a very strong year for equity markets, the key questions looming for investors on the immediate horizon are focused on A, whether US exceptionalism can indeed continue, and second, how are markets likely to behave between now and Trump's inauguration in mid-January, which it's about a month away, particularly given the number of political risk events we've already experienced around the world in just the past week alone. So, to discuss these questions and more, today I'm very happy to be joined by Audrey, who's the head of asset allocation at the CIO office. So, welcome, Audrey. Thanks for joining us today. Just sort of looking back, US equities have gained about 29% year to date, following a pretty strong 26% in 2023 as well. That's obviously widened the performance gap with other markets. So, do you expect this to continue?
Well, we believe that President-elect Trump's policy are likely to lead to another year of US equity market outperformance in 2025. However, prudence would suggest investors also stay diversified and be nimble to hedge against potential risk in the year ahead. So if you look at our strategies, it continues to hold a slight preference for US assets. And at the same time, we also remain overweight gold to hedge against potential geopolitical uncertainty. Trump has already notified key trade partners such as China, Canada, and Mexico in terms of his plans to impose stiff import tariffs. And it remains to be seen whether the threat of tariffs is simply a negotiating tool to achieve his policies of or objective of attracting investments into the US, or simply an advance notice of building walls to protect domestic industry against imports as well as to reduce the trade deficit. And of course, how key trade partners like China and Europe respond will be equally important. And given the divergent objectives in terms of tax cuts, deregulations, as well as import tariffs, how Trump eventually goes about balancing these seemingly divergent objectives will be quite key for markets in the coming months. And then if we look at inflation so far, expectations here has been quite well behaved. And we do expect the Fed to look through any initial rise in inflation due to the tariffs and continue cutting rates by 75 basis point next year after an expected 25 basis point cut later this month. But certainly any rise in inflation expectations could well lead to the Fed continuing to hold rates and potentially upending the bond markets. So, in terms of this rather uncertain backdrop, we would remain positioned for another year of US exceptionalism, but also advocate investors to be nimble to changing dynamics, especially if Trump's policy lead to significant fiscal policy easing, whether is it from China or Europe over the coming month.
All right, thanks, Audrey. Maybe let's now take a slightly shorter term lens. In the US, we're approaching obviously the holiday season. So, where do you see sort of sectoral opportunities ahead of that seasonal period in the US? And also wanted to get your thoughts on Korean equities, given we obviously had some fairly dramatic events over there in recent days.
So, if we look at the preliminary US holiday season sales data, it does point to continued upbeat momentum with consumer spending rising by about over 7 percentage point on Cyber Monday, and with more than half the sales being transacted on mobile devices. And against the backdrop, we continue to favor the likes of technology as well as the communication sectors in the US, in particular focusing on digital advertising and e-commerce subsectors. So if you look at the earnings expectation of both sectors in 2024, it has since been revised higher since the start of the second half of this year and are now standing at 20% for technology and close to 24% for communication services sector, which is relatively healthy and certainly outpacing that of the S&P 500. Now, in terms of Korea, we have been underweight Korean equities within Asian ex-Japan. The recent and brief declaration of martial law simply adds to the list of of headwinds against Korean equities. And President Woon's potential impeachment or even resignation would certainly impact fiscal spending and weigh on the economic outlook for next year as well. Additionally, if we look at Korean equities, as many people are aware, they are quite highly leveraged to the semiconductor sector, which could be an area of focus by incoming President Trump hawkish trade policy. So against that backdrop, we do expect MSCI Korea to continue to trade at a discount to its longer-term averages, and the discount is likely to persist, if not even widen, as we go towards 2025.
Thanks, Audrey. And I guess just moving over to Europe, I guess in France is the other market that's made headlines. It is sort of deepening political stalemate rather. So, as we know, the government there has lost a motion of no confidence that's ended up removing the current prime minister from office. In your view, what are the implications of this political uncertainty for both the European Central Bank rate decision, but also for the euro and European government bonds?
Well, in the case of France, political instability is likely to persist, given that the government now face a potential shutdown in January. From bonds perspective, negative sentiment so far has been relatively subdued if we compare that to late June, when President Macron called for snap elections. If you look at the 5-year French CDS, which is a measure of sovereign default concern, it rose from 31 basis point to 40 basis point in less than 2 weeks. But this increase so far is quite modest if we compare that to the 16 basis point jump back in June. And secondly, the French 10-year bond yield has also continued to trend lower alongside expected ECB rate cuts. And then last but not least, if we look at the spread between the German 10-year bond yield as well as French, in terms of the difference between German 10-year bond as well as French government bonds, that only rose by about 10 basis point, which is just 6 basis point more than during the Macron episode in June. So given this context, we do believe that European government bonds on an FX hedge basis continue to remain an attractive, opportunistic idea. And we see current volatility as a potential opportunity to add to this idea against the backdrop of still pretty soft economic data in Europe and also a high likelihood of continued ECB rate cuts. And then in terms of euro dollar, that has been surprisingly resilient despite all the political turmoil. And we see euro dollar potentially, testing support at around the 1.033 levels over the next 2 to 4 weeks, given that the PMI, whether is it from a manufacturing or service perspective, is still quite weak, and that is in contrast to the more robust economic data and strength that we see in the US.
Okay. Well, thanks very much, Audrey. I think we'll keep it short and end the podcast conversation at that point. Thanks very much for taking the time to join us today. If I can sort of summarize the key takeaways from today's conversation, first is that Trump's policies suggest U.S. equity market outperformance can continue. But of course, our view would be to be sensible and take that view within diversified portfolios. Second is that year-end holiday season sales do bode well for our preferred technology and communication service sectors, of course, also in the US. And finally, political risks in Europe mean that it's quite likely the euro-dollar pair is likely to test support just above 1.03. So that's brings us to the end of today's podcast. Thanks very much for listening in. We do expect to publish our 2025 outlook in the coming days, so please do keep a watch out for that. In the meantime, of course, we wish you a very happy weekend, and we look forward to speaking with you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.